Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest. I'm speaking with Ike Iossif, who runs the website MarketViews.tv. We have talked multiple times during the year. Ike's one of the top gold timers in the world, actually. But today we're going to talk about something different, and I'm going to ask you, Ike, first, how you doing today?
I'm doing well, Mike. Thank you.
Well,
How about you?
I'm doing good. The market's kind of funny. The VIX is trading at a historically low level for this amount of time. The volatility is completely gone. On one hand, a lot of people aren't worried at all, but then on the other hand, there are people worried because this is historically strange action. And one thing people are wondering, and I'm wondering myself, do you think that stock market crashes can be predicted?
Well, Mike, we need to break down the subject because when we talk about a crash, what we're talking about is a rapid and large-scale decline. Now, that can happen with individual stocks. That can happen with entire markets. Over the years, I have made several observations. I know people are fascinated, with issues like this. So we can break it down and analyze it issue by issue. Okay. The first thing that we can talk about is a single stock crash. That is when you have just a single stock, let's say AOL back in 2000, or Vertical Net or Purchase Pro, to name a few, that came down, crashed and burned. In late 1999 and early 2000, something that I noticed, something that you noticed, was that breakouts stopped working. And not only they stopped working, but actually stocks were rolling over and losing 20, 30, 40% of their value in a matter of a few days. Naturally, it caught my curiosity, and I started looking into common denominators. What I found out throughout 2000, and something has been confirmed over and over and over again, and the data that I'm showing are data that I have collected from June 1st of 1999 until June 30th of this year.
Oh, okay.
Okay, so we're talking about conclusions that are based over 17 years worth of data. And I have found that when it comes to single stock crashes, 4 conditions existed in all of them. What I want to make clear is this: just because those 4 conditions exist, it doesn't mean the stock will crash. However, all stocks that have crashed have fulfilled those 4 conditions. Okay? So, and those 4 are, first of all, you have to have a parabolic move.
Well, let me ask you this before you get to the 4 conditions. How much does something have to drop, and how quickly for it to be a crash?
I would say in excess of 30% in a matter of 5 to 10 days.
Okay.
When we're talking about a single stock.
Okay.
When it comes to markets, that's different.
Okay.
But 30, 40% in a matter of a few days, 5, 10 days, I think that qualifies for a crash. Okay. So anyway, going back to those 4 conditions that I have observed. First of all, what preceded the crash was a parabolic move. Now, that parabolic move included the following. We had a rising price in excess of 300% in less than 120 days. At the top, the price was 30% above its 20-day exponential moving average, and simultaneously 250% above its exponential moving average. In fact, most programs now give you the opportunity to use several filters in order to find stocks. You can enter this criteria, and I'm pretty sure you'll find some stock that fulfills all four of them. And most recent example of what I'm talking about is GBTC. This is the ETF for Bitcoin. If you look at GBTC, we find out this. The closing price on March 20th was at 106. The closing price on June 6th was 546. And that was the top, the closing top for GBTC and the top for Bitcoin. The net gain was 440 points or 415% in less than 90 days, and in less than 120 days. Second, the closing price on June 6th was 546. The 20-day EMA was at 375. The net point difference is 173 points or 45.6%. And on the same day, June 6th, the price was 546. The 200-day EMA was 150 or 264%. So you can see right there in the most recent example how all these four conditions were met on June 6th, and look what happened afterwards. From 546, it went down to 300, and then it made even a lower low at 250.
Yeah, 50% drop.
Yes.
Kind of nasty.
Yeah, well, I think that qualifies for a crash.
Yeah.
Okay. So when it comes to individual stock crashes, I have found this criteria to work. And I said, I have studied data going back to June of 1999. Again, I want to emphasize that just because these four conditions are present, it doesn't mean the stock will crash. It can go even higher. I mean, these conditions can become even more extreme. However, once these conditions are met, I think you should watch out because the probability for a crash is rather high. Now, moving on, the next type of crash is a stock market crash, when the entire market crashes. And here I want to differentiate. We have, in my view, two types of stock market crashes. The first one is the one that happens over a few days or weeks. Like, for example, what happened in 1987, and I have the chart there. We can see that Dow went from a low above 2,600 down to 1,600 in a matter of a few days. In fact, in one single day, it was down 20%. All right, that's the Dow back in 87. Moving forward, we go to 2000. You look at NDX, the Nasdaq 100. It went from 4,800 on March 24th, if I remember correctly, down to 3,200 initially in early April, in just a matter of 10 or 15 days. And then it went about 2,850 by late May. I think that qualifies also for a crash. Although this was only the prologue, so to speak, because eventually Nasdaq went down 85%.
Yeah, it was terrible.
Of course. But we'll talk about that as the conversation goes on. But I'm talking about the initial drop.
Okay, right, off the high.
A drop in a few days. That qualifies for it, okay? We can see something similar, okay? Another recent example, and that was the Shanghai Stock Exchange. We can see that from roughly April of 2015 to March of 2015, it had gone from 2,200 to 5,200. And look what happened afterwards. I think that also qualifies for a crash. I mean, we went from 5,200 to 3,600 in a matter of about 3 weeks. I mean, this chart speaks for itself.
Yeah.
In analyzing data since 1925, I have found that prior to this type of crashes that took over a few days or a few weeks, in all of them, regardless of what market we're talking about, the US market or European markets or Asian markets, two conditions existed. One was we had price gains in excess of 100% in 8 months or less. And B, at the top, the price was 50% above its 200-day EMA or greater. And if you look at all three charts, you will see that holds true in the examples that I just mentioned, okay? The only problem with this is that the samples are few. So in my view, the statistical significance of the findings is low. What I will say is that if you have a market that fulfills these two conditions, then you better watch out. You could very well have a significant decline. But whether it's going to develop to a crash, that's something that, as I said, statistically, you cannot say with any confidence. What I want to add, though, is something else, that you can recognize the conditions that can lead to a market crash. But just because these conditions exist, it doesn't guarantee that one will happen. You and I were talking privately a few days ago, and I gave you an example, which is you could very well have somebody spill accidentally a gallon of gas in his backyard. That doesn't mean it's going to catch on fire. The conditions are there, okay? But somebody has to light up the match. I mean, you have to have a spark.
Right.
Without the spark, just because the conditions exist, it doesn't mean you will have a fire, okay? Usually, what I have observed over the years is that the trigger is some event that causes investors to suddenly change their risk preferences. And all of a sudden, from risk tolerant, become risk averse, which causes massive selling. That event could be anything, but it is a random event, and I don't believe it's something that can be predicted. To put it all together, I think a market decline is an event that can be predicted, but a market decline that becomes a crash is not, because a crash is a random event. And the fact that we have had two crashes since 1929, two in the last 90 years, that proves the randomness of the event.
Well, that would suggest to me that the important thing to do isn't to try to look for evidence a crash is coming, or even necessarily worry about it that much, but more so to focus on the conditions that can lead to a bear market or a meaningful decline or correction.
Exactly. And that brings us to our next subject, which is our next type of stock market crash, which I identified as losses near or in excess of 50% during the course of a bear market. There's one thing to have 20-25% losses in a matter of a few days, and another thing to have 50-60% losses in a course of a bear market. That, to me, that is also a crash, okay? But it's a different kind of one. Now, the duration and the magnitude of the bear market, I have observed that are relevant to the excesses of the prior bull market. and also whether the bear market is a result of an economic crisis or the collapse of a long-term speculative bubble. And last but not least, you could also have an unpredictable major catastrophic event that may happen during a bear market, such as 9/11. We already had a bear market. We were already in the middle of a bear market when 9/11 happened. That is a catastrophic event that is unpredictable. So that event exacerbated the losses during the bear market. Okay. So, in conclusion, after having studied the markets for 28 years, and having the privilege to have learned from some of the most respected technical and fundamental analysts for 20 of these years, I have come to this conclusion. Predicting simultaneously the exact time of the start of the bear market, and also its duration, and its magnitude, and the time of its ending, like for example saying, well, on August 28th, the market will top at 25.50, for example, and we're going to see a decline in excess of 30% over the next 12 months. I think that kind of forecast or prediction is improbable and perhaps rather impossible. However, what in my observation is probable, doable, and possible, and I believe within the duties of us as analysts, is to recognize the fundamental profile of the market, the valuations level of the market, B, the technical profile, divergences, for example. And last, and most important of all, the price action, which altogether confirm that the market climate is in transition or it has taken place already. In addition, I think what is also probable, doable, and possible, and is based on a number of different improvement methodologies, is to identify price zones and time windows at which intermediate or long-term market trends can take place. Like, for example, a well-proven cycle, which is a 17-year cycle, has held for over 100 years. Every important market turn in the last 100 years has been marked by the 17-year cycle. The turn of the cycle is in 2017. For someone to say that 2017 is an important time window, to me that is to me that makes sense. Okay. So nevertheless, the important thing is that confirmation by price and technicals is needed in order to determine that the market indeed turned within the expected price zone and during the expected time window. When price confirms it, it means your initial expectation is correct. If it doesn't, then you have to go back to the drawing board and look for the next possible time window, for the next possible price zone. Now, in recent history, there are several examples, and I have listed three, where all three of the above conditions were met, and I'm showing with the arrows the time at which you could see them, okay? For example, with the NDX, the first confirmation of all three conditions, fundamentals, technicals, and price action, came in mid-June of 2000, and another one in early July, and a third one about the third week of August, and a fourth one in late in October. Now, if you were looking for all these three conditions to be met, you probably missed the top at 4,800. But if you got out at 4,000, or you shorted Nasdaq at 4,000, you still avoided about 75% of the decline, and you still made a whole bunch of money. Moving forward, I have another example with the S&P 500. The arrows show at what point in time, based on the criteria that I discussed earlier, you had confirmation. And we can see that the confirmation came around at about 1400. The S&P had already declined from 1550 to 1400. So it had already lost 10%. But if you shorted there or you got out there, you still avoided another 40% of the decline because the S&P eventually lost about 53% of its value. And if we move to the latest example, we have the first time we got confirmation was in October of 2007, and we got a second confirmation in May of 2008. And in fact, those of our listeners who have been listening to me for over 10 years, they may recall an interview that I did in late May of 2008 with Jerry Appel, the inventor of the MACD. And during that interview, we were talking about the poor price action and the poor technicals. And the thing that I referred to was that the weekend before the interview, I had taken the time to look at all 2,000 stocks that make up the Russell 2000, and 2/3 of them were in bear markets.
Oh, I remember that time period in that interview very well because the market peaked out, and I remember where I was talking to you on the phone about that and about that interview, and the VIX was barely moving and the market was going down and fell into August, and we had a final wimpy bounce, and that was the end of it. It was something.
Exactly. Now, in terms of technical divergence, and you just mentioned the VIX, I have said many times during our interviews that what is important with regards to the VIX is not that much its absolute level, but its strength. And I have said that one important technical evidence is that when the market goes sideways or higher, and the VIX is making higher lows on a weekly basis, and we can see how this preceded the bear market of 2007-2009, and also it also preceded the decline that we have had in August of 2015 and January of 2016. That's a sample, an example of the technical divergences I'm talking about. Now, with regards to present existing conditions, what we have right now is only the fundamental part of the equation. We don't have widespread technical divergences, and we don't have confirmation by price. But in terms of valuations, right now, the market is about 4 or 5% below where it was in March of 2000. This is the second most expensive market in history.
Yeah, it surpassed the other high of 1929.
Yes, it did. Okay. But again, right at this moment, we don't have the technical divergences and we don't have the price action. Now, what should be noted is that the S&P has entered an important price resistance zone. That is between 2,500 and 2,550. And at the same time, an important time window. And I referred earlier about the 17-year cycle. So the S&P is in an important resistance zone, is an important time window, but price has to confirm. I mean, we need to see whether it's going to turn or not. Another point I want to make, though, is that on a short-term basis, given how overextended the market has been above its 20, 50, and 100 day moving averages, and B, the level of complacency and bullishness among investors. I mean, last week, the difference, the week before last, the difference between bulls and bears in the investors' intelligence report was 41%. So, with this kind of conditions, sharp and steep declines that seem to come out of nowhere can happen at any time. At any time, you can have a 10-15% decline. We saw that in NASDAQ the first part of 2000, between January and March of 2000. Although the market went down 10%, turned around and recovered. And then it was down 10%, and then it recovered. That can happen any day, any week, given the existing conditions that we have right now. But as far as saying that the market is going to crash, or the market topped yesterday or the day before, right now we only have one part of the equation, the fundamentals. The technical divergences are not there, and the price action is not there.
Well, so, I think that from an investment standpoint, the high valuations to me tells me there's better places to make money over the next couple of years than the stock market at this point. Go ahead.
Oh, I agree. In fact, as investors, one of the things we have to do is look where we can get the best return for our money. The best return with the risk parameters that are tolerable to us. Okay? So, if you look at the market from a risk-reward point of view, perhaps there are other places to put your money.
But the other thing I think too is the last time we've seen a correction in the stock market was between July 2015 and January 2016, and then before that in 2014, and then in 2010 and 2011 there were quick declines. One of them was that so-called flash crash event, and preceding all of them there was a technical deterioration in the market. For instance, the percentage of stocks above the 200-day moving averages was declining for months going into the top of 2015, and it declined sharply over 4 weeks going into the correction of the fall of 2014. It just happened like overnight, over a couple weeks, and then the market dumped. And none of that's happening yet, but I'm very worried that it could happen very quickly over a couple weeks, and that would signal a real drop, but that's not happening yet. But it makes me really have my eyes open. That's
if you look at the bullish percent index, the S&P, for example, it topped around 80%, I believe, in late February. And at the time, the market was around 2375, 2400, something like that. Since then, we have moved slightly upward, and the bullish percent index for the S&P as of yesterday was 72.5. There is a slight divergence. However, sharp declines have happened after the bullish percent index has fallen below 55%. Okay, so a slight divergence is there. A rapid deterioration could happen very quickly.
Oh yeah, well the type of internal divergence I'm talking that can precede a real drop. When that flash crash happened, that divergence took place over like 4 or 5 days. It was like instant. Exactly. So that it's like
it has to do with what I mentioned earlier. It has to do with the rapid shift in investor risk preferences. They go from fully tolerant to totally risk averse.
And it could be anything that makes that happen. It could just be some decision that, oh, stocks are overvalued and lots of people with big money flee, or the economy is bad economic news and they say, oh, the valuations don't justify this, or disappointment over Congress, or who knows what, it's a war or Trump going crazy, or who knows. Who knows. But right now, no one's worried, at least in regards to the stock market action. The VIX is low and the market's not moving much, but it's that's the kind of economy we're in. The price action is dull in a certain sense, but so much weirdness on television. If you turn it on any day, it's so crazy now. It's crazy.
Yeah, I agree.
But it doesn't matter right now for the stock market. So it's I don't know. It's just, I think we're in very interesting times, and it just makes me keep my eye open, and we have to. I know we're navigating and watching these things every day, every week together, and hopefully we'll be able to spot these changes before they take as they start to take place. Because we were able to do that in 2008, and when was it I first met you? I think it was 2001 or 2002. But it's interesting times we're certainly in regards to the financial markets, even though at the moment they're not moving a whole lot. But that's kind of what happens when you get into that transition phase. The moves start. So we'll see what happens. But do you have any other thoughts? I interrupted you at the end.
No, I think pretty much setting up for taking. However, we will elaborate further on the current condition of the market when we do our next interview, which probably will be sometime in September.
Okay, well, I'm looking forward to that, and have a good weekend, and we'll talk later.
Thank you, Mike. You too.